Okay, how are you guys? Cool. So, first, without looking at my map whatsoever, you see how far I get with my memorization. Then I got a bunch of announcements. We'll go over the last two topics in the 8 toolbox items, which are accounting and financial analysis and capital and resource acquisition. Then talk a little bit about the quiz again, and we'll call it a day. Cool? So, Gracia, right? Jacqueline, Silvino, Richard, Melina would be sitting there, but she's not here. Leanne, how are your teeth? Not good? I'm sorry. Oh my God, are you serious? I'm sorry. Well, enjoy the relative peace of this evening until the surgery of tomorrow. Joshua, normally Nathan would be there, but I think he's got a job interview. Hema, normally sitting next to you there would be Megumi. She's going to be a little late, I think, because of her son's soccer practice, and that would be Shelby, right, on the other side of you. And then Miguel, Javier, Spencer, right? Okay. And then Maria and Alyssa would be there. Brian, Rainier, Vanessa, Abby, Vincent, Rochelle, Kaya, Shelby, right? Yeah. Majid, Sabrina, James here, Chase, and then we're missing, hang on, Paige, right? Okay. And then Susie. Chase is there. Susie and Christian. And Samuel, Jonathan, and I don't see Hernan. Is he here? Okay, so we're missing Melina. Nathan and Megumi and Alyssa and Paige and Hernan, and there's Alyssa. Okay, cool. Hey, I didn't even have to look at the map. So, okay, I got a bunch of announcements, and then I'll dive in on the lecture for today. So first of all, you remember the extra credit from last week before? There was an opportunity to fill out a survey for 10 points of extra credit. Almost everyone did it. I think I've recorded your extra credit at this point. There's a couple people that I didn't get, so I want to make sure that if you did do it, you send me your confirmation, because I couldn't find your student ID number in the list that Gloria sent me. Or if you haven't done it yet, because out of 35 students, there's only 5 of you that haven't done it. I feel bad that only 5 of you don't get Christmas presents. So if you haven't taken it yet, and be honest with me, if you don't have the confirmation that you already did it and you haven't taken it, you can still get 5 points this week. So, Chase.
Yeah, I was going to say I did it.
You did it.
Yeah, did you get one? You know how we were supposed to end at the last? Because mine is a 0. I think I may have rolled in. But did you get one that had 4 digits?
Yeah, but I found you.
Oh, so you got me?
Yeah, the only ones that I don't have recorded. Alyssa, did you fill out the survey for extra credit?
I did it, but my computer didn't work or anything like that, so I haven't.
Did you fill out your student ID number at the end of the survey? Can you send me your ID number again? It didn't. There's a couple ID numbers that were I think you might have typed in the wrong number.
I might have put in my AV.
It might be. So
I've been doing that.
send me both, because there's a couple numbers that I couldn't attach to a person. Okay, so email me about that. Hernan's not here, but if he hasn't done it yet, he still could. Maria, you the same as the other class, right? So send that. I think you may have already sent it to me. I can't remember. Did you? Okay, there's some emails I haven't dealt with yet today. Samuel, did you fill out the extra credit survey?
I did not.
Okay, if you still want to, you can do it by the end of the week for 5 points.
Okay, thank you.
No problem. And then Melina's not here, and I don't have hers. Okay, that's it for that. Other announcements. So I've got several like job and career / extra money earning opportunity announcements to make. I'm going to try and do more of that as we go forward, and tie it in with our career center as much as possible. So first of all, one of our consultants with our Small Business Development Center is working on a project with a real estate investor here in town. So he's providing consulting to someone who looks at potential properties to buy or invest in. And he needs someone to do basic accounting and financial projection work, $15 an hour. It would start probably 5-10 hours a week, but there's a lot of work to do, so it could end up being more hours than that. It could even end up turning into something full-time. So if you already have a job and you just like to make some extra money, it's an opportunity. If you think you might like to get into that, there's a lot of work to be done, and it could turn into something full-time. So anybody that's interested in that, email me, and I'll put you in touch with Jay Thompson, who's the consultant that's running the project. Okay? That's the first announcement. Second announcement. There's various events that our Career Center does on a regular basis that they should be advertising directly to you guys, but I want to underline the events to you as well. There's 2 that I've already missed, unfortunately, because I've been busy with the rest of my stuff for you rather than doing their advertising. But most of them for the rest of the quarter are still going on. The ones you missed are on your resume, which I'm pretty much helping with anyway with your LinkedIn profiles. And there was one on interviewing from last Thursday that I was not able to tell you about in time. But there's something actually, unfortunately, going on right now. So you're not going to be able to go to it because you're in my class. But it's on career fair networking. And then so tomorrow from 12 to 1, there's a session in Dorothy Donahue 104 on networking and reaching out and various things that you can do with your LinkedIn profile after you've created it and you've made the edits that I eventually send you, which I'm going to be writing up as much of them as I can this weekend. So that is tomorrow. There's an internship and career fair on October 14th from 10 to 1 in the Runner Cafe Quad. Again, when I was talking about your professional development plans, even though internships often are not paid, if you're interested in getting into an area that's hard to get into or is a passion of yours long-term but not an immediate job prospect, it's a good way to get your foot in the door with stuff. So that's the 14th. October 21st, rather, there's a session on choosing your major, which most of you in here are like seniors and juniors, so you probably already have, but in case that's still relevant for some of you, that's there. There's a graduate school fair on November 4th from 11 to 1 in the Runner Cafe Quad. So any of you considering doing a master's or going to grad school for a PhD, whatever, it's a good information session. And then there's also like preview session on that for prepping for the networking and contacts on October 28th. And then finally, for anybody that's graduating in fall of 2015, there's a session on November 9th about sort of what's next after you graduate that might be useful. So I'll post this flyer on Blackboard as well, but some of the things that are happening right away I wanted to tell you guys about before any more time passes. Next, moving into the rest of the year, there's also going to be a volunteer fair that the Career Center hosts on February 3rd and a career day on February 29th. So just a heads up to you guys that those things are happening. I'll also post that stuff in Blackboard. I just got a couple of brand new job announcements as well that I wanted to tell everybody about in case they're interesting. So Consolidated Electrical Distributors is looking for management trainees. Deadline is October 15th. Target is recruiting for their distribution center internship. Like basically a whole bunch of stuff, executive team leader, store executives intern, distribution center, group leader. There's a bunch of stuff that Target's recruiting for, so if anybody's interested in stuff at Target, there's a bunch of stuff coming up. I do not have the deadline. October 16 instead of 15 is the deadline there. And then Ross is also recruiting, the big like discount retail store, recruiting for retail leader internships. So that is looks like end of October, 23rd, 24th is the interview dates, and when the deadline is for the application, I'm not sure. But if anybody is interested in any of those, and you can't, it should be listed on the Career Center's website. But if you can't find it and you're interested, please let me know. I'll make sure to get you hooked up with those opportunities. Finally, we've got an internship opportunity at Teltech, which is a Bakersfield. You guys know what Teltech is? It's a security company here in town. I don't know if it's paid or not, but I do have all the information on it and attachments if anybody is interested in that. So obviously, as an internship, it's not going to pay much. It's kind of a way to get your foot in the door, but it may pay. I don't know. If you're interested in Teltech or that opportunity, let me know. I'll give you the rest of the info as well. Okay? So those are all those announcements. One other announcement that I had before going on, and I thought I had it in this big pile of papers, and it looks like I don't. So I'll have to do it off the top of my head. I went through and looked at all the implementation projects and did a little brainstorming about who to invite as guest speakers for the quarter. That's something I sort of alluded to at the beginning, and I haven't talked about again yet because I wanted to get an idea of who would be most appropriate. My mentor for a long time now, ever since I was at UCLA for my MBA, his name's Bruce Rungland. I met Bruce originally because there's like this entrepreneur secret society thing. It's kind of like the Illuminati of the entrepreneur world. There was a club or a group on campus where we meet once a month, and it was partially like kind of a support group for all of us that were like trying to start businesses and frustrated that nobody cares about it and we're not getting any funding and all that. So we'd meet once a month. Half of the day was kind of like a support group, and the other half of the day we'd meet with some big successful entrepreneur around Southern California. Bruce himself was the owner, and it was a family business that he took over from his family and then built into the third or fourth largest corporate travel agency in the United States. And he sold it back in '98 for God knows how much, probably 100 million or more that he cashed out on that. So Bruce pretty much never has to work again in his life, and he likes to help other entrepreneurs. So he started doing some angel investing. He was advising entrepreneurs like me when I was on campus at UCLA, and I usually have him talk in this class a lot. So I'll probably have Bruce talk to us via Skype about just the general world of being an entrepreneur and a small business owner. I think I'm going to have our SBDC director, Kelly Bearden, come in and talk with us because we're doing a project with crowdfunding there. We may hook up the scooter project with resources from the SBDC as well. I think it'll be good to have Kelly come in. So that's our Small Business Development Center, SBDC. I may have one of the consultants from there come in and speak to us as well. Jay, the one I just mentioned that had that opportunity with retail or real estate. I'm going to find. I know a couple speakers who are. They've been entrepreneurs with like interesting, innovative products of one kind or another. I also know some people at Tesla. One of them, like given the fact that we're working on the scooter project and like there's several people that are on that, I may have somebody come in that would be specifically relevant as like the trials and tribulations of trying to get an invention that's actually a physical product of some kind from idea to manufacturing stage. I also may have a restaurant speaker of one kind or another come in. And I probably will have if I can get the timing right, I'll have the director of the Downtown Business Administration come in and talk to us so that that covers the Fox Theater project plus the downtown business association projects besides that. So those are my initial thoughts on guest speakers for the quarter. I just wanted to give you guys a little sneak preview of that. I'm going to email and call everybody this weekend and see who I can line up for what dates. So basically, after next Monday, when you do the quiz, next Wednesday, we'll kind of kick off what the goals for each of the projects are and get you guys started working on the work there. And then some sessions will just be working on the projects. Some sessions will have like half the session or the whole session with guest speakers. So that's pretty much what the second half of the quarter is going to look like. A combination of you guys working in your groups and taking class time to work on these projects and me to help you with them. And sometimes we'll have guest speakers talking. So as soon as I've been able to call everybody and reach out, I'll know better who's coming and when, or who's going to be on Skype and when. So little preview there. Any questions about any of that before I go into the lecture? Okay, cool. So moving into the lecture. Good, we're recording. Okay, so course documents, at this point we've gone through most of the stuff in here. What's still left is accounting and capital. Accounting and capital and resource acquisition. So the longer title is accounting and financial projections. So accounting financial analysis is the first PowerPoint I'm going to go through, then capital resource acquisition. I got a couple of examples to show here, and then we're done. So on the accounting and financial analysis side of things, hide that. So, some of you are more familiar with this than others, but it's something that I think is important for all small businesses. It's really easy to collect money online these days. So some of you are already familiar with how to install PayPal or another credit card collection possibility on a website. Some people aren't, but there's a lot of small businesses out there in this world that still are not collecting money online as easily as they could. So basically, if you're going to be collecting anywhere up to a couple grand, you can go into PayPal. Who in here is like downloaded PayPal to a website and used it to get paid for things before? Majid?
For eBay.
Okay, but for anybody for an actual business to like have people pay you with a credit card? Leanne? So before I talk, do you want to tell your familiarity, or your teeth hurt too much? Okay, I'll talk. So basically, you go to the PayPal website. Click on the basic download link. Takes you all of about 5 minutes, maximum 10, and you've got a little button on your website that people can click on, and they can enter their credit card information and pay you. Like PayPal will collect the money from the credit card. PayPal will pay the money to you. Basically, you give PayPal your bank account information. The money can either be immediately transferred to your bank account, or it can accumulate in PayPal, and then you just tell PayPal, I would now like to transfer this to my bank account. So without, or they'll cut a check too. So PayPal takes a fee. It's actually not cheap. Yeah, PayPal hard charges like 10%. So they're more expensive than if you use somebody else like TSYS or Merchant Warehouse. If you use a normal credit card vendor company, you'll get better rates. But if you don't have credit worthiness, you're not going to get approved to use one of the other credit card agencies. PayPal, you can pretty much be anyone in this world and collect payments up to a couple grand without anybody asking any questions whatsoever. It's pretty dynamic. I was blown away with Market Driver, just how easy it was to start having money flow into my hands. It's like pretty cool, but it's like the most you're going to pay is for PayPal. It's pretty expensive, but it's the easiest to get started with. Once you've got some creditworthiness, or you've established some track record with the small business, if the small business itself is more creditworthy and or the individual owners, these other vendors are a better solution. It's cheaper, and you can charge a lot more money, or collect a lot more money. And like I said, they have a couple percentage points on the online vendors there. I've given you a little bit of a chart here on information of what I know. The numbers are slightly out of date for TSYS and Merchant Warehouse. So anyway, that's a little bit of information there. Moving on, revenue and cost estimates. So like it's a basic concept, but it's something I can't like stress enough in this class, and I really want to like focus on. Like, everybody in here probably knows that profit is basically your revenues minus your costs. Whatever's left over is your profit. But a big problem that most startups have, and I certainly like dealt with this a lot with both of my startups, Avenue 2 was my licensing company, and Market Driver, which was the lead generation company. Like, revenues are way too low and your costs are way too high. It's the standard problem that like most small businesses have, and is the reason why most small businesses end up failing. Is because you just don't have enough money coming in, and you got too many costs. So when you're doing projections in particular for financial analysis for any small business, whatever you think the revenues are going to be, after you've made your projection, like, make it a fraction of that, especially if it's a new product or a new market that you're trying to get into. The more established the market, the more realistic the projections. But anytime you're sort of going into uncharted territory trying to grow revenues, whatever you think they're going to be, they're probably going to be a fraction of that. And whatever your costs and your expenses you think they're going to be, like, multiply that by 2 or 3 times, and that's probably what your costs are going to be. There's all kinds of costs that you don't expect that come up and end up adding up over time. So what we're going to get into in a second here is like the financial statement preparation 101. Some of you all should have been exposed to this in some of your like earlier accounting classes, but for those of you who are not accounting majors or for whatever reason didn't quite like get it when other folks taught it, I will go through it again. The pro forma projections that you put together for financial statements, if your expenses, like, you should always overestimate on all possible expenses and always underestimate on what you think the revenues are going to be, rather than vice versa. And then 2 more points that are important to remember, especially as a small business owner or manager. Pretty much, like, especially when you're starting up a business, the bigger it gets, the less this is the case, but the smaller and the newer the small business, it's going to basically consume almost all of its own revenues. So when you're starting on a new venture, or you got a small business that you're trying to grow in a certain direction, don't expect to earn any money off of it for yourself. Like, the first thing the business is going to do is pay for itself, and eventually it's going to generate revenue and income for you. The bigger the small business, the less that's the case. The smaller the business, the more it pays for itself but doesn't have much profit left over. And then finally, it will basically consume every penny that you can find anywhere. You can beg, borrow, like, get your friends and family to invest, whatever. You'll always have need for more money. It's like a vacuum cleaner for, like, there's a giant sucking sound of the business taking up money. So make sure that you think ahead as much as possible about your expense projections. That would be my general message about any time you're estimating revenues and costs in a small business. Some more details. It's really important to be be clear about what customers are reasonably willing to pay. And if we go back to what I talked about in customer acquisition and guerrilla marketing, like, in my opinion, you want to have a profile of what your target customer looks like for each of your niches. You then want to estimate how much more or less could this niche bring, and be very conservative and realistic about what the niche is going to bring. Like, if you think, if we go to, if I use the beauty salon as an example, like, if you think realistically, of a certain type of customer, let's say like 40-something women, that's the sweet spot of like a particular salon. If you know of 5 current customers that are really good customers, and you'd like to grow it to, theoretically you have enough time with the people that are doing styling there that you could actually service 20 per day. If you don't know where those 20 are going to come from, and you don't have 10 times as many leads as you do like planned revenues, then you're probably unrealistic. Like, you need, like, if there's not 10 potential new customers for every one that's gonna turn out to be a real customer, you're estimating too ambitiously. So be conservative in what your estimates are for how many customers you can realistically get and what they're realistically willing to pay, and based on those revenue estimates, you may find that you're not bringing in enough revenues to actually like hit your goals or cover expenses. In that case, ask yourself whether there's other niches that you're not addressing. Eventually those would get product service vignettes attached to them, where you have a profile of the customer, you estimate the market, and so forth. So be realistic there, and once you've sort of maxed out the realistic potential of one type of customer, think about what other niche, what other type of customer you could also go after, rather than getting unrealistic or ambitious about the number of customers in a certain niche that you can reach. For possible expenses, I've listed some major expenses that most companies have here. I highly encourage you, when it comes to expense projections for small businesses, to like do a brain dump and brainstorm, like go out to every source possible and make a list of everything you could possibly ever imagine that might come up as a cost. Because like Murphy's Law, I promise you, if it could possibly be an expense, it probably will be at one time or another. And hopefully you don't have to spend it, but it's better to plan for it and then plan ahead to see if you can avoid certain expenses than not being prepared for them. So on the variable cost side of things, depending on what you're doing, raw materials, sometimes transportation, labor costs, obviously including payroll and taxes and benefits. For all of those, also important to consider what quantity do you have to buy them in. So if I look at the auto business for a second, it would be nice if we talk about the radiator shop for a second, it would be nice if you could just buy one radiator from the radiator suppliers and keep it in stock, but normally they don't like to do that. They like to sell them in boxes of like 50, so it's really important to realize what's the minimum quantity that I can buy. It's great that each of them costs me, $200, and I mark them up and sell them at $3, but if I have to buy 20 at a time, that's $4,000. Wait, no, so it costs me 200, I said? What did I say? 200 times 20, yeah, 4,000. So if you don't have $4,000 in the bank, then it doesn't really matter if you can mark them up and sell them for 300, because you can't get them until you buy $4,000 worth at a time. So very important to know whatever your business is. A lot of times, if I go to sort of more labor-driven or intellectual property-driven businesses, one of the things I was unrealistic about in Market Driver, I planned on hiring people and paying them hourly to do all of the like emailing and phone calls necessary to find leads. But the quality of talent that I needed, like nobody who was a really good salesperson was willing to work for me just per hour. Like they needed an assurance, like I'm gonna make at least 20 grand out of this project or I'm not signing on. And I don't have 20 grand laying around, so I can't hire the kind of talent that I need because I have to pay it out like 2,000 at a time, 1,000 at a time. I can't agree to 20 grand up front. So sometimes even if it's possible that you only need 10 hours or 20 hours worth of labor, and you could pay about $10 or $20 an hour for that, you may have to hire somebody at least half-time or full-time in order to be able to get them instead of them doing some other job. So even though it's possible, sometimes you can't get labor in extremely small quantities because it's great that somebody works for you 5 hours at like $20 an hour, but that's $100 for them, and that doesn't even cover like groceries for a week. So if all you're going to offer the workers is 5 hours at $20 an hour, you're probably going to have a hard time keeping anybody because they're not going to be able to make enough money to pay the cost of their life. So with labor as well, realize how much is the minimum that you're going to have to be able to buy in one chunk of somebody's time in order to be able to get it. Moving on, marketing costs, brand development, advertising, networking, especially for small businesses, the meal expenses for taking people out, having drinks with people, driving back and forth everywhere, sometimes flying if you need to go further away to network with people. More so than the investment that you make in advertising, the biggest expense for a lot of small businesses is just all the expenses that come up by like going all over God's green acre trying to like talk with people and network. Overhead costs, depending on the business, office space, utilities. I've listed a bunch here that are useful brainstorming places to start. I would recommend that if you're doing a cost projection project for a small business, you look at this list and ask yourself, is it possible that I might have this expense? If so, I should put a line item in for it somewhere. And just like check off every one on the list to make sure you haven't missed anything that might be an expense you didn't consider. And then finally, executive compensation. Like after all of the rest of these costs are done and those realistic, sometimes smaller than expected revenues come in, whatever's left over is what you get as the owner of the company, or what the owners of the company get if it's not your company. So, realize that you need to plan on, like a lot of times I was just psyched to prove that I could do something with both of my businesses. I wasn't in it mainly to make a profit. I was in it because I was going to prove to the world that I could like start this licensing company, that I could book deals in the music business. And the same thing with my my sales lead company. And I really didn't think about, is this business actually generating enough profit to pay for my rent and my travel plans and my student loan debt and everything else? Like, it wasn't making enough money to cover the rest of the costs of my life. And rather, it took me a long time to accept the fact that these are micro businesses that I was running and they're not making enough money to really pay me the level that I'm worth if I were working for somebody else. So after everything else is subtracted, realize that whatever's left over that's all the owners are going to get. So if it's not very much, then the owners better either have savings or a side job, because otherwise they're not going to be able to pay their rent and their living expenses. Moving forward, there's, for all of you who are not accounting majors, there's 4 major types of financial statements that, like, the entire accounting world and eventually the entire like finance and like investment world is based on. The first one is called a statement of cash flows. The second one is called an income statement. Third is called a balance sheet, and the fourth is called a statement of shareholder equity. So I've just done screenshots here for you of like what the 4 look like. The attachment, the extra, so the last 4 slides in that presentation are screenshots. I'm going to switch back over to Blackboard here and pull up the spreadsheet that I did those screenshots from and show you guys a couple things. So this is an example that a bakery. One of my projects that I had back in Cincinnati was a small bakery, and I had them put together financial. This is actually projections for new revenues for the next 5 years for a project that they wanted to do. So it all starts with going in and actually writing down line item per line item, like revenues that are going to come in. So basically they were focused on providing catering for weddings, for birthdays, and for basically sports extravaganzas. So like at the end of the season, Megumi, I think you said you just came from your son's baseball practice. So at the end of the baseball season, usually there's some kind of party for the team, and they were focused on providing the catering for that party. So those are the 3 kinds of customers they had, and they're predicting, basically, in January we're going to be able to bring in 2 birthdays, 1 sports deal, and 1 wedding deal. And they went through, and these are the approximate amounts of revenue that each of them will bring in. You'll notice each of these is hard-coded into the cell that it's in. This is just simply going into Excel and putting a date, a description, and an amount in a big long list of every possible place that money's going to come in, and like each time you get paid and what date it is, how much it's going to be. And if you go down all the way to the bottom here, that's what they've predicted for the year, and that all adds up to about 83 grand of revenues for the year. And anyone who in here is familiar already with how to get a bunch of cells in Excel to add up to something? Okay, for those of you who aren't, like everything above this cell, all they did, or I would do if I put this together myself, is to hit the little sigma sign here in the upper right hand corner, and then highlight all of the cells that you want to add up together, and then just click enter, and it adds up all of the numbers that are above it. For any of you who are not that familiar with using Excel, that's what you need to do. And then if we go down here to expenses, they did the same thing with all their expenses. So they expected to have some networking costs in January, like spend $100 taking people out to dinner. They're going to have to pay for the basic supplies for the bakery. They're going to print some brochures up. They're going to print some flyers up. They're going to be subscribed to a couple of different databases, and then they're going to have salaries to pay themselves and the people that they have working for them. Then they got some telecommunications expenses, rent, utilities. So they just list out item by item. When is the bill due? What is the nature of the payment? How much is it? And the idea here is to get these. You want these lists to be as long as possible. Like, it's better to plan ahead and then be happy. Oh, great, we didn't actually have to pay for flyers this month. But if you think you might need to, then make sure that it's in there, and make sure you're relatively realistic about how much it's going to cost and about when you're going to have to pay it. So the main thing here is date, description, amount, both for all your costs and all your revenues. And try to get as much in there as you possibly can. So if it's revenues, do not put it down if you do not have a very concrete, realistic way of expecting that you're going to collect it. On the expenses, if you think in any way, shape, or form you might have to pay that money, put it in there. So expenses should end up being a really big number, and revenues will be a small number. That's not the way you want it in the end of the day, but it's much better to plan on the worst case scenario and how you're going to deal with it than hope and pray that things are going to be better than expected and then have them not be. So that's the point of the exercise here with the statement of cash flows. If you look all the way down here at the bottom, we then have the same sum for all of the expenses. This, I just put this cell equals whatever's in this cell. And then here, and then now, I'm going to say that this cell equals the total amount of revenues. And this cell right here is simply all the revenues minus all the costs. So basically, this is actually not monthly. This is for the year. So they basically got $83,000 worth of revenues, $77,000 worth of costs. So there's $6,000 left over of profit at the end of the year. That's the statement of cash flows in a nutshell. You want to have an Excel spreadsheet. You could use other software, but you basically want to have a big long list of every single time money came into the company, what date did it came in on, and approximately what was it for. And the same thing for expenses. Everything you could possibly expect to pay for, approximately what day you have to pay it and how much it is. Big long list. You add them all up and you get totals for the year. Then there's a separate tab here, income statement, that the income statement is basically a summary of everything that happened in 1 year financially in the company. Okay? So for year one of this company's operations, rather than having each individual wedding deal, each individual birthday deal, each individual sports deal, all of the money that the company collected for or is projecting to collect for revenues in the first year is included in this cell right here. So something that's very useful in Excel that some of you already know how to do, some of you may not, is basically making a cell in one spreadsheet like based on adding up numbers or based on a cell in another spreadsheet. Okay, so the way that I created this number here is I went back to the statement of cash flows. First of all, I sorted, rather than having these, right now these are all sorted by date, so they start in January and they end in December. And I want them instead sorted by category. You'll notice they each have a category. They're either weddings, birthdays, or sports extravaganzas. So if I go in and I do data, sort, and I tell it to sort on category rather than date, that'll put all of the wedding revenues in one place, all the sports extravaganzas in one place, all the birthdays in one place. Now I can simply go to the income spreadsheet and I can tell it, you click the equals sign, I want this cell to add up, this was weddings, right? I want this cell to add up everything that's in these cells. You just click, like left click and pull down to highlight that and then click enter. And of course, it's not working for me right now. What's that? Oh yeah, thank you. Equals sum, and we'll put all that in parentheses. Yeah. So sometimes it does that automatically. Sometimes I actually have to put the sum words in there. I can't tell you why. Sometimes Excel understands that I want sum, and sometimes it doesn't. But so to make sure that it works, you click equals in capital letters SUM, and then two parentheses. Put your cursor inside those parentheses, and then go to wherever you want to add things up, left click and drag to highlight all the cells, click enter. Got it? So that may be familiar to a lot of you. If it's not, I just showed you. So basically, we did the same thing with birthdays. We did the same thing with sports extravaganzas. So because I calculated this again before, because I calculated this before differently, I'm going to recalculate the three numbers now so they add up to the right thing. This was sports extravaganzas? Yep, no, birthdays. So this is going to be all of these. Yep. And this equals sum, parentheses, put the cursor inside of them, go over here and highlight all the sports extravaganzas. Hit enter. You'll notice 83,750, 83,750. So we want the subtotal of each of those three areas here, and then we're going to do the same thing for the costs. So if you notice, things are broken up into either marketing, variable costs, overhead costs, or compensation. I did the same thing with those, sorted according to the category, and added up what was in each of those. So that gives us a total amount of revenues in each category for the whole year, and a total amount of revenues in each expense category, or a total amount of expenses in each category for the whole year. These numbers are simply, again, taking whatever's in that cell and putting it here, and taking whatever is in C8 and putting it here. This subtracts the two of them. And then you'll notice we have year 1, year 2, year 3, year 4, year 5. So year 1 is actually based on all of those numbers in the statement of cash flows. Years 2, 3, 4, and 5 are estimates based on a multiple of those numbers. So let me go down to the other numbers here for a second. So after you get the operating revenue number, normally in your income statement, there's two important things you have to include after that. One is your interest expense. Most of you, and we'll get to this when we go to capital acquisition, like most small businesses have some combination of like credit card and line of credit debt. They have bank loans and they have equity investments. So the bank loans and the credit card debt, the lines of credit, you have to pay interest on that debt. So theoretically, you want to pay the principal back too, but even if you maintain the principal where it is, you at least need to, and you have a cost associated with the interest on the loans. So make sure that you've got a line in here for interest expense. You'll notice that in this template, which I encourage any of you who end up doing a financial projection project for one of the small businesses, you can use this spreadsheet. Just change the numbers and change the title at the top, but a lot of the formulas are already like typed in. So you need to change the formulas when it's relevant, though. So for example, this spreadsheet is based on an estimate of 15% interest on a $10,000 line of credit. So you'll notice hard-coded into this cell is $10,000 and 15%. If that's not what the actual business is pending for interest expense, you need to change what's in that cell. Same thing. So taxes, you can change this to be more accurate depending on how much information the small business gives you to work with, but ballpark numbers, corporate taxes are significantly lower than individual taxes. Like, you pay more in income taxes in general in this country than you do in corporate revenue taxes. Ballpark figure is about 20%. Once you sort of cap out with the highest salary possible as an individual, you end up paying more like 33, 35%. But you're usually not going to pay much more than 20 for as a business. Depending, sometimes it's different, but that's a ballpark in here. So whatever is left over, you'll notice that this cell basically takes whatever the profit was, subtracts from that whatever the interest expense was, and then whatever's left, multiply it by 20% and assume you're going to have to give that to the government. That leaves you with a, like, it's da. So earnings before interest. This is actually not before. So there's a term called EBITDA, which is earnings before interest, taxation, depreciation, and amortization. This should actually say subtotal, like EBITDA, because we've already got the interest and taxes in there. Depreciation and amortization are listed here. Again, they're based on percentages. So any business that sells physical products of some kind, you're going to have a certain level of inventory shrinkage. So that just means things get broken, things get lost, things get stolen. If you have like a bakery, eventually the cupcakes go stale and you can't sell them anymore. You have to throw them away. So that's all included in inventory shrinkage. And then finally, depreciation and amortization. Depreciation is basically when you own any physical asset, like this like monitor here. It probably cost I don't know. Let's be, for simple numbers, maybe it cost us $500, and we're going to use it for 2 years. So the depreciation would, and after 2 years, we're basically going to assume that it's worthless, and we're going to have to buy a new one. So first year, the depreciation on this is $250. The second year, it's $250. So we paid $500. Over the course of 2 years, eventually this thing is worth nothing. Or if we could resell it for $100 after 2 years, and we wanted to go through the trouble of doing that, then we would depreciate $200 first year, $200 second year, and then we'd have another line item in our like transactions where we take $100 out of assets and put it back into, like, we take it out of physical assets and put it into cash assets. But anyway, anything where you own something physically, you need to depreciate the value of that over time, because it doesn't maintain the same value over the course of time. Again, these cells are hard-coded based on the assumptions that are in the comments column. If the assumptions about the business that you are doing work for are different, you need to change those numbers, okay? And then finally, everything here in year 2, year 3, year 4, year 5 are based on the assumptions that are in the comments column. So you'll notice here, year 1 is the totals of the category entries in the pro formas. Years 2 through 5 are assuming a 10% increase in revenues per year. So you'll notice this is just C5, whatever's in that cell, times 1.1, which is a 10% increase. And then whatever's in E5 gets multiplied by 1.1, so forth and so on. We're going to assume that costs grow less rapidly. Like, as you get bigger, you're going to have more costs, but hopefully you get more efficient at doing things. So proportionally, your costs go up by less of a percentage than your revenues. So the assumption built into this spreadsheet is a 5% increase in cost per year. Those assumptions are probably not correct for the business you're doing estimates for, so you need to go back and change the numbers based on what the correct projections are. But you can use this as a template in general. That's the income statement in a nutshell. Balance sheet is basically the status of how much money you have, how much money you owe at the end of each year. in a small business or any business. The balance sheet, that's what the balance sheet does, is say, as of December 31st, or sometimes companies will end their year in June 30th, or whenever the end of the year is, as of this date, this is how much money we have, this is how much money we owe, and this is how much money is left over in value. Okay? So the normal accounts that you have in a balance sheet are going to be cash. So whatever is sitting in the bank is an asset. Accounts receivable basically means that somebody signed a contract and agreed to pay you something, but you haven't received the money yet. A lot of times, if somebody pays you with a credit card and you're collecting it, like we talked about at the beginning, through PayPal or something, PayPal goes pretty fast, but sometimes if you're using another credit card vendor, if somebody charges $10,000 on their card, you won't actually get the payment until 30 days after it gets charged. So it depends, but basically at any given time, there's going to be some business that the company has that the customer agreed to pay it, but you haven't actually collected the cash yet. All of that goes in accounts receivable. And then you're normally going to have at least two other categories: short-term assets and long-term assets. Short-term assets are basically things that you're going to use within 1 year, and long-term assets are things that like this monitor. If we're going to use it for 2 or 3 years, it's a long-term asset. Probably if I had 10 boxes of pens, that'd be a short-term asset, because I'll end up using them and they'll run out of ink and I'll throw them out by the end of the year. So basic difference. Normally inventory, so the radiators actually would go in short-term assets because you're planning on selling them within a certain year's time frame or whatever. Same thing for any kind of supplies that were sold in a beauty shop. If it's a salon and we're talking about clothes and stuff too, inventory is usually a short-term asset rather than a long-term asset. The scooters in inventory for selling would probably be a short-term asset. The manufacturing equipment used to make them is a long-term asset, etc. I've put, again, some basic assumptions into this spreadsheet. So first of all, cash, we're assuming that, first of all, we're assuming that this was originally made for a relatively new company. So we're assuming that when the company was started, there was 10 grand that was placed, you got 10 grand in money together from various investors, and you plunked it down into a checking account, okay? So the assumption made in this spreadsheet is that, when the business started, Sucre here, this bakery, they got $10,000 together among the founders and their friends and family, and they put it in a checking account. So starting in these projections is the 10 grand that they originally put in cash, plus whatever was left over in profit on the income statement. So this 3,075 here. Oh, here. So plus whatever's left over. So this is basically 10,000 plus whatever is in this cell. But I did one additional, there's one additional edit there, because they didn't know in their projections exactly how much would be accounts receivable and how much would be cash collected already. We put an assumption in saying whatever the revenues at the end of the year are in the income statement, we're going to assume that 11 out of 12 months we've collected on, and whatever we made in December, we haven't collected yet. So whatever the number was from the income statement was multiplied by 11/12, and added to cash, and then 1/12 of that number was put in accounts receivable. Does that make sense to everyone? And you'll see here the estimates in this column are describing the assumptions. When you do a project for business X, Y, or Z, you probably will need to change the numbers that are in these cells to match with whatever the business is actually, what their actual numbers are. Short-term assets, we made an assumption in the case of Sucre that they would take $2,500 worth of investors' capital, and they would plunk it down in. They would use it to buy inventory and supplies and stuff like that. And then they would also take $2,500 worth of investors' capital, and they would use it to buy like baking, like an oven and tables and a computer to like do calculations on, and they would put that in long-term assets. So you'll notice here, $2,500 minus whatever the inventory shrinkage is, because short-term assets includes your inventory. So if you have to throw out some of the cupcakes, or you lose some of your like boxes of pens at the end of the year because somebody that you had doing accounting for you like took 5 boxes of pens home with them and then they didn't show up the next day, eventually you're going to have some lower level of inventory. So you have to go in and subtract whatever's here every time. Every time I put my cursor somewhere and go somewhere else, it like changes stuff. So you notice that's 2,500 minus whatever was in B25 in this sheet. Make sense? And then same thing for long-term assets. We have to subtract the depreciation. So 2,500 minus whatever was in B26 is going to be the ending value of your long-term assets. So add all that up. Basically, in this case, that means that this bakery at the end of the first year of their projections had $17,825 worth of value, 391 of which is like cash in their checking account, 308 of which is like bills that like they sent to customers, but the customers haven't paid for them yet. 1,875 is what's left over in inventory, and 2,250 is the remaining like value. If they were to like sell the oven and sell the computer and everything tomorrow to somebody else that wanted to buy it, they could sell it for $2,250. So that's all of the things that they own of value. And liabilities, they took on, oh, excuse me. So the 10,000 here was actually not from investors. Basically, we made the assumption, which is common with a lot of small businesses, you open up a line of credit or you have a credit card and you immediately max it out and use the cash to cover business expenses. So in this assumption, they got a $10,000 line of credit from the bank, and they immediately moved all of that money over from line of credit to cash. That's where the 10,000 came from here. Excuse me, it wasn't, in this case, it wasn't investors' money. It was a line of credit with the bank. So that's where the 10,000 came from here, but you got to pay the 10,000 back. So in your balance sheet, you also have to list the fact that you owe $10,000. So great, we got the cash in here, but we got to give the cash back. So when you subtract that, we've only got $7,825 worth of actual value of the business left over. And that is then, you'll notice here, year 2, year 3, year 4, year 5 are similarly calculated, and we're not assuming any capital payments down on the line of credit. In most businesses, you would basically take money out of cash and pay down some of the liability, and then the liability would go lower. Right now, the simple spreadsheet here did not assume any payments on the debt. In a lot of actual projections, you're going to have payments on the debt there. So that's that. And then you'll notice here at the bottom, shareholders' equity. That's what's left over. So anybody that owns the business, like they own a part of that $7,825. The fourth and final statement is the statement of shareholders' equity, which basically is just dividing. It's dividing the equity among the shareholders according to what percentage they own. So in this assumption, we actually assumed that there were 3 different investors. So they went to 3 different family members. They cobbled together $5,000 in investment from those 3 family members. So 5,000 divided by 3 is what, about 1,700 or so, 1,650 per. So they got about $1,600 per family member from like three rich uncles and aunts, you know, and they took that money, $5,000 total, and they used it to buy supplies. But in exchange for that $1,600 a piece, they gave 25% ownership of the company to each of those 3 relatives, okay? And then the founders, they didn't put in any of their own money, but they took on the $10,000 worth of debt responsibility, and they're the ones working on it every day. So in exchange for putting in all the work and the labor and having the idea in the first place, they get 25%, okay? So you'll see here, shareholder 1, 2, 3, founders. Normally, you would end up changing this to be the actual name of the shareholder, but since this is a generic template, we just got the titles there. And you'll notice this is simply whatever is in, so this is equals balance sheet, shareholder equity number, times 0.25. See? And it's the same thing for the other 3. So assuming that each of the 4 shareholders in this case owns 25% of the company, they each basically, if they were to sell, like, okay, I want to get out of the company today, you can pay me like my share in cash, and you can have the stock back. Each of them would get $1,956. And you'll see as the company grows, this is how much the value of the company is worth to each shareholder going forward in the projections. Does that all make sense? Yes, no, maybe? Questions? Okay. Recapping quickly before I go on to capital and resource acquisition. There's going to be a question on the quiz about things to consider when you're estimating revenues and costs. There's going to be a question about the types of major financial statements. There's going to be a question about how to calculate certain things in cells in Excel. And that's it. And there's 4 questions basically on there's only 3 questions that are based off those slides. Okay? Those are the 3 things to think about. Moving on. Close this. Don't save. Close. Moving on, capital and resource acquisition. That's our final topic to go over. So, obviously, we've now gone through 7 out of 8 tools that I think every small business professional should be able to do. First thing was web development. Second thing was product development, which basically had a lot to do with patent and trademark filings. That's what we did last Monday. And then last Wednesday, we talked about guerrilla marketing, customer acquisition, sales, and we talked about doing competitive research on the competitors of the business. Those are the second 2 things. We did those last Wednesday, sorry. Then 2 days ago, on Monday, we went over doing research on your industry in general and trends that are affecting that industry. And then we did how to do research on better ways to do things operationally in the business. So contracts, legal, HR practices, all that stuff, how to do things better in the company. And then today we just went over financial projections. So being able to like either calculate accounting numbers for the company or make projections for the future. And then the last thing that's important for any small business professional to be able to do is to go out and find investors for your company and or other resources for the company. And that's what this last one's about. So there's three main sources of capital for any small business. One is credit card debt and lines of credit. That is usually the way that most small businesses initially get up and running. And the amount of credit card debt or line of credit that you're able to get is basically based on your personal credit rating and the financial situation of the owners. So if you are better off financially and you have a better credit rating as an individual who's starting a business, you're going to be able to get access to more credit card debt and more lines of credit. But that's all based on you as an individual, not based on the business, because it's a new business, and a new business has no track record upon which to like make bank loans or anything like that. So it's initially based on your personal credit rating and the situation of all the owners financially. Once the company gets up and running, bank debt is a lot cheaper than lines of credit and credit cards. Lines of credit and credit cards are the most expensive way to finance your business by far and away. The interest rates are ridiculous. So once you get up and running, you're going to want to get a more traditional bank loan instead of using a line of credit or credit card company. Most small businesses that you're going to be doing projects for are in this bank debt stage already. But they'll probably have some leftover debt that came from the initial startup of credit cards and lines of credit. In order to get a bank loan, you basically need the assets of the business. So the business has to have some kind of assets, cash in the bank, your long-term and short-term assets that we just mentioned in the balance sheet. You need to provide financial statements of the business to the bank and a basic business plan. You don't want to give them like everything in the kitchen sink, but you're going to want to give them documentation about where the business has been, what is so valuable about it, and where it's going. Those three things, plus the personal credit rating of the owners, is going to enable you eventually to get bank debt. But that usually comes a little bit later. Most of the businesses you're working with are going to have a combination of those two. And then the third major source of financing for any small business is, there's actually four. Sorry, I have a whole separate page on equity investors. The third source, which I didn't used to focus on as much in this class, but it's a really important part, especially for certain types of businesses. So grants are a really great source of money. The great thing is you don't have to pay them back, you know? So sometimes you can go for grants right away, right? Even when you start your business. And certainly as you continue going on, there's always grant money out there. So one of the projects we did last spring in this class, I think the project that had the most value of all, I had 5 students working on a project for a water, clean water solutions. I told you about this a little bit, water recycling. The state of California had this huge bond issue last year, Proposition 1. Everybody remember it, or some people remember it? So Prop 1 got passed, which means the state of California is now allowed to go out and sell $25 billion worth of bonds, and then take that money and give it to all the different water conservancy agencies around the state. And then those water conservancy agencies will invite all companies in their region to submit proposals. Here's what we could do to help make more water available in California. And they'll choose the best proposal and they'll just hand out the money to them, like $250,000 a piece. So that's nice money, and you don't have to give it back. You just get the $250,000 and you do the work on your project, and hopefully it creates value for the state of California, because obviously if it doesn't, you're probably never going to get another grant again, and you're not going to have very many friends in the state legislature. But you don't have to pay it back. You just get the money and you do your best, and that's it. So the thing that you have to have here is not so much credit rating, but you got to fill out a lot. There's an incredible amount of paperwork involved with most grants. That's a lot of what the students did, was to figure out exactly what is the form that this company has to fill out. If it had been more than 10 weeks, the students would have actually filled out the paperwork and just had the company bless it rather than spending all their time to fill it out, because it's very time consuming to fill out the paperwork. There's all kinds of kooky eligibility criteria, so it has to be a business which was founded in San Diego County. I bet that one of the conservancies only wants companies who were either founded there or have 51% shareholders who are from San Diego County. Okay, if you don't have it, then you don't have it. There's all kinds of weird eligibility criteria and bureaucratic requirements where you got to fill out three of this form and then 10 of this form, and every 3 months you have to fill out 5 more forms to tell the government like what you've done with the money. There's a lot of paperwork that you have to go through, but the money's free and you don't have to pay it back. So another source of capital. The fourth source, equity investors. So this is both when you first start out and when you get up and running. So most small businesses start out by getting money from friends and family. In general, that tends to be people that have at least 10 grand worth of personal savings sitting around that they otherwise aren't using for anything. If you got more than 10 grand sitting around that you don't need and it's just sitting in a money market or a savings account somewhere that you can move relatively easily, peeling off $1,000 or $2,000 to invest in somebody's business that's a friend of yours or a family, it's doable. So anybody that's got less than $10,000 just sitting around in a savings account somewhere, probably not a good target for your investors. Upwards from there, you're talking about getting a couple grand here, a couple grand there. That's the nature of like friend and family investments. We're not talking about $10, $50, $100,000. Obviously, if you have more wealthy contacts, you may be able to get more money from them. But normally, you're talking about a couple thousand here and a couple thousand there from friends and family. The higher the personal savings, the less risky it is. So if I have personally, one of my goals financially is to have like a rainy day fund sitting around. I think I mentioned a little bit of this when I was telling you guys about like budget planning for your personal professional development goals. One of my financial goals, which I haven't reached yet, but isn't like an active goal that I'm like putting money towards, is to have escape pods in my Rebel cruiser, just in case we're overtaken by an Imperial Star Destroyer and I have to jettison the droids with the plans really fast. Like, you never know what's going to happen. I could show up here tomorrow and the dean could be like, hey, you know what? Like, the president decided to cut some of our budget. Like, you're the new guy. Sorry, we don't need you anymore. Like, it's happened. It's happened over and over again in my life. Like, you want to have a rainy day fund. Like, you never know what's going to happen tomorrow. I doubt it. I've got a pretty safe situation right now, but who knows? Who knows what happens tomorrow? So one of my goals is to have 18 months worth of my burn rate sitting around, like in a savings account. Bless you. To just have, just in case I show up tomorrow and Darth Vader is like in my office and I gotta get out of town fast. I got money so that I have time to transition to a new university. But if I had, and I think my goal there, my short-term goal is to have about, I think 4,000, burn rate's 4,000. I think like more or less 75 grand was my goal to have sitting around in savings. The short-term goal is, I think the short-term goal by the end of the year is like 10, So as of the end of the year, if I actually had 10 grand sitting around in my savings just for rainy day, and I just had an awesome meeting with the dean, and like he loves me, all of my colleagues love me, there's no way that it looks like I'm gonna like be out of Dodge tomorrow. I could probably peel off $1,000 and give it to one of the small businesses in this room, and get 10%, get 5% or 1% of the company or something in exchange for that. I still got $9,000 left. It's not too much skin off my nose, but if I had $100,000 sitting in the bank, my long-term stretch goal is to have 75 sitting there. If I had 75, hell, like peeling off 5 or 10. If I really believe in the business and I think like you're going to end up doubling my money for me in 5 years, it doesn't hurt that much. It just means that if I lose my job, I have to find a new one 1 month sooner. So the more money you got in the bank, the less risky it is to peel off a little money. But in general, when you're looking for friend and family investors for a small business, they got to have at least $10,000 sitting around with nothing else to do with it. Otherwise, it's going to be too painful for their monthly budget to be able to free up the cash. They should get some kind of personal enjoyment or satisfaction out of it. There's a lot of things I could do with my $10,000. If I were to invest it in a business, I would either have to A, really believe that it's going to succeed, or B, Samuel and Jonathan's project back here. I like the music business. It would be worth it even if all the business did was break even and I never made any profit off of it. I'd be psyched to have a little bit of an equity stake in an active DJ and music event business around town, just so that I could stay involved with the music business, because otherwise I'm too busy. So a lot of times you don't just want somebody that's got the money, you also want somebody who has some kind of personal interest in it. Otherwise, I'm not going to, no offense to beauty salons or transportation companies or restaurants, but I don't give a crap about those things. Personally, if I'm going to waste $1,000 and see you guys see the small business burn up my money, I'm gonna blow it on a business that I like. So that would, in my case, probably be music or a couple of other things. Or if I really believe in the business and I think it's going to work, then I'm also, regardless of what kind of business it is, I'm interested. Partners and in-kind resource providers, basically bigger businesses that are going to come in, either provide you with their resources in exchange for a joint venture deal or some kind of percentage interest in stock in your company. Obviously, Chevron has a hell of a lot more money sitting around in their savings account than any one individual has sitting around in theirs. So if Chevron thinks wow, the scooter company, actually, we don't care about the scooters, but the way that you're using the lithium batteries, actually, sooner, we got to do some side ventures where we develop sources of fuel that aren't based on oil, or eventually, and we're just going to do that because we want to have a good public image. I could see Chevron giving money for maybe, it's just an example, I could maybe see Chevron peeling off money and giving it to a venture like that, just so that they could say in their annual report, hey, look, everybody hates us because we're causing global warming, but look, we also invest in lithium battery projects, and they could probably peel off $500,000 or $1 million to do that, just so that they look good publicly because they have that kind of money. So you're going to be able to get a lot more cash from businesses without that business actually having to take over your business. They might want a small percentage, or they might want your company has to sign a contract saying, we will provide demonstrations each month at Chevron corporate PR events around the country in exchange for this money, but otherwise you don't have to give up any stock. It's an example. So another source is other businesses, and then the third source, venture capital, angel investors, and crowdsourcing. So crowdfunding, Kickstarter, etc. This, I have not done projects on that before. Kelly, our small business development center guy, like I said, he and his son, I think, raised about $20,000 for a food truck business last year, pretty easily doing that. That's awesome. If I put together some cool looking pictures and a good story, put it out on Kickstarter, and like people think it's cool and they give me 20 grand, then I don't even have to pay it back in that case. Like I may have to like agree. May have to put a line item in my budget. Like I got to make sure to keep like 5 grand set aside because I promised to like pay for plane tickets for the lucky winners. But you may or may not have to give equity. And you also could say, okay, like I said in the contract that you might offer, maybe each investor can choose. They either get like 1% equity or 10,000 frequent flyer miles or like a $500 travel voucher. And like, so some of it gets equity, but the rest, some of it gives up equity, but the rest is money coming in for other things that you give up. But basically, crowdfunding means that you put together something, put together some materials, put it out on a website platform like Kickstarter, and individuals go in and invest small amounts for a variety of reasons. Sometimes just because they think the business is cool, and they're investing so little. Each individual is investing so little that they don't need equity in return. If everybody puts in $100. $100. I pay $100 for. I paid $400 for my damn like PG&E bill last month. 100, like I sometimes spend 100 just on dinner when I'm paying like for me and somebody else, and I wasn't paying attention to how much dinner cost. $100 I just pay on a weekend for entertainment. So I could just as easily if I thought, oh my God, that business is super cool, and if I get little certificates that I can put up on my wall twice a year showing like I am an official investor in the scooter company and here's the latest thing that they did, and I can like hang it on my wall and like show people, that might be all I need for like the $100. Anyway, one source. The second source, venture capital and angel investors. How many people in here know what the term angel investor means? How many people know what venture capital is? Okay, so I'll explain both. In reverse order, angel investors are basically people like my friend Bruce. Instead of having like 75,000 in the bank and I could peel off 5 or 10, Bruce has like 50 million in the bank. So for Bruce, peeling off 500,000 or $1 million, that's the same as me peeling off 5 or 10,000 out of my 75. So if Bruce thinks a business is cool, he, out of his personal funds, could throw in $500,000, $1 million. That's an angel investor. It's an individual person who has a large amount of personal wealth, and they can invest in your business. Finally, venture capitalists are basic. Venture capital is basically a company which goes around to a bunch of individual angels and says, okay, Bruce, you give us $1 million, and we know 20 other people that'll give us between 1 and 5 million, and after we get all that done, we've got 50 million together. And we'll take, as a company, we'll go out and we'll take that 50 million and we're going to search for the best 2 high-tech ventures we can find, and we're going to sink that 50 million into these 2 high-tech ventures, and we're going to try and turn it into 100 million within 2 years. Like a venture capital firm basically just aggregates investments from individual angels. Sometimes they bring in pension funds and stuff like that. They gather together a bunch of capital into a big pile, and they invest it in companies that have a lot of potential. So that's what those 2 things are. I put in big capital letters here. Venture capital and angel investment almost never happens. Like everybody, when they start a business or they have a small business and they're dreaming about getting more investors, they think, oh, geez, right around the corner is some like Daddy Warbucks kind of person who Bruce is just right around the corner. If I just met Bruce on the right day, I gotta have $1 million of investment. No, you can meet Bruce on any day, and he's a really nice guy, but he ain't giving you that million. Bruce is not going to part with $1 million unless he's damn sure that it's a good investment. And a lot of times, but Bruce, for example, only invests in businesses that he understands. So, Bruce is relatively low tech, so he's not a big technology investor.
He's not going to invest in social media stuff. He probably is like, he's not going to invest in a music venture because he doesn't really understand that. He might understand restaurants, but if you do understand restaurants, you usually understand that they're really dicey business. So most people don't invest in restaurants. So he only invests in certain kinds of business. But that being said, so most of the businesses in the world, most small businesses, are going to look for a long time until they find the right investor that actually feels good about that. And venture capital firms, a lot of venture capital firms, for example, only invest in technology projects. Like, they don't even look at beauty salons, restaurants, trucking companies, apparel companies, breweries, auto companies. Just forget it. Like, if it doesn't have to do with software or like hardware, like computer hardware and software, we don't even want to see it. And there's a lot of investment that goes into just IT and a couple of other industries. So that being said, like, you can't win if you don't play. So you want to have your materials out there in the marketplace, circulating with angel investors, circulating with venture capital firms. You might, you can't win the lottery if you don't play. Usually you don't win the lottery, but somebody does. So you got to make sure that you've got your materials out there to give yourself a chance. So executive summary. Okay, so I've got an example here. First of all, the first thing that you want to have to be able to circulate to investors, to be able to place on Kickstarter or crowdfunding sources, is a basic executive summary of your business. So I have, if we go back to Blackboard here, an example of an executive summary from one of the projects from last year's student projects. If I open that up, basically it looks like this. So on one page, you've got like a basic description of the product, a basic description of who the customer is, basic description of how the marketing is going to be done, what the competition is like, what the financials are, and how things are going to be implemented. Period. One page, nothing more than one page. One page which says, this is what we do, this is what our customers look like, this is what our competition looks like, this is how we do our marketing, this is how much money we have right now, how much we expect to make, and this is who the people are that are doing it. This is how much money we'd like from you. Period. Like, very short to the point, nothing more than 2 or 3 sentences, one page. That kind of document is really important for any small business to have. There's also some mission, vision, goals, exit option stuff here. Not always as important. It is important at least to have your exit and harvest options in mind, but that's a bit beyond the scope of either A, what's on the quiz, or B, what I expect you guys to know coming out of this class. I'll just say briefly that exit options, so how many people in here are familiar with the term exit options? And then harvest options? Probably like a little bit less. I have my own definitions of these terms. So exit options are normally like, exit options are what are you gonna do with the company to like either sell it or bring in more investors and have somebody else run it. Like, exit options have to do with how you leave the business and somebody else buys it, or how you eventually grow and bring in professional management. Exit options are more about like, exit options to me are like, what happens if the business is successful? Harvest options are what happens if the business is not successful. So basically, both of my businesses that I started, Avenue 2 and Market Driver, like, I still file business tax forms each year for those companies. For the last like 4 years, I just write all zeros in all the forms and I submit it because I haven't done anything. But they still exist. I still know, like, I still, if the time zone difference were different, I might have Mo Feeney my client, one of my music business clients that I worked with a lot, talked to this class about how his experience in starting his business. Unfortunately, he's over in Bath, England, so the time zone differences work bad for talking to this class at night. But you know, what that business has turned into is basically once or twice a year, I like refer Mo to a couple of like new contacts in Brazil. Every once in a while, he delivers like guest lectures to this class, and we both have a useful contact. That's it. You know, I'm not making any money off the business, but I have a networking contact that like can get me cool backstage passes to shows if I ever wanted to go to various stuff. And Mo has a networking contact that he knows that can hook him up with good people in Brazil, because I still know everybody there. So the harvest option is what happens if nobody wants to invest in your business. It's not scalable. It's never going to grow big, but you work your ass off trying to like get it to work. So, you know, maybe it turns into a hobby. Maybe it turns into a little like, it is a business, but it's basically something that you run yourself with one friend, and you spend, you know, 2 weekends a month on it, and that's all the bigger it ever is. And it's something between a hobby and an extra source of income. That's how I would define a harvest option, as opposed to an exit option. An exit option is what happens when you're successful. Harvest option happens what happens if you're not successful. And then below that, I've also got a list of a sales plan. This is not as important to circulate to investors, but it's very important that every small business have sort of a short list of here's our top targets that we think will invest in the business. This is who they are and why we think they will invest. This is how much we'd like to get from them. So it is important for the business to have that list. That's not normally something that you're circulating to investors. This first part on the first page is what you're circulating. So that's that. Couple more things, and then we're done for the day from current slides. So I've put together again a couple of different information sources. For capital acquisition. You know, just talking to friends and family, networking with people you already know, asking them how much they have in savings, and you know, do they ever invest in businesses? Telling them about your business, asking, like, just doing that in networking with people you already know. LinkedIn, another thing in addition to like giving you career like contacts and so forth. It's a great way to find people who have an interest in one way or another they have an interest in one way or another in seeing transportation companies succeed. So, you know, I might be able to refer you guys to various people who are either in the transportation business or they're in retail, so they might be potential customers, but they also are big enough that they'd like to see more cold storage transport options from the West Coast. I don't know. So LinkedIn is a great way to go out and find people as well who might be potential investors. Small business loans. I've actually put a little link in here to the SBA's website about small business loans. I also, it's brand new information that I just got, but I was at a like, great. I'll update that link for you guys. If you copy and paste the link instead, it might work better. So anyway, the SBA's website, if you copy and paste the link that's in here rather than clicking on the link, is a good source of information. I have a brand new source which isn't in these and isn't in your quiz, but I was just at this like strategic planning retreat for our local small business district here in Central California, and there was a great presentation by a guy from Celtic Bank, which is a small niche bank based out of Utah. I mean, they basically have some rich dudes in Utah that threw their money together and like put together a bank, and they specifically do small business loans. So lots of information on how exactly what the credit approval criteria and stuff are that I just got recently there. And then Google, always a good source of information for almost anything. If you search for like grant or investor, there's all kinds of associations that like organize all the investors in the world out there, or all the grant information out there in a certain area. You can certainly do a lot of Google research on potential companies that might be in-kind donators for the company. Grant funding, most of what the student project did in the spring, looking at that Prop 1 grant funding, was just sifting through Google and looking at the results until they found the one that actually describes what the like application criteria are. And then finally, you can do Google searches on individual wealthy people who might be potential investors. I've put together some information sources specifically for grants here. This is a great page on the Small Business Association's website about various grants. There's a whole like page for government grants just called grants.gov. This is all kinds of federal grants. California state grant money, california.gov/grants. The California SBDC, so the whole, not just our Cal State one, but all of them in California have a nice little page on grants as well. And then grantwatch.com goes beyond government grants to all kinds of not-for-profits, foundations that give out money. So I've listed these for you. If your project is to help the small business find grants, like 5 great resources there for the business. Investors, I put a couple stuff up here. Funding Post is a great sort of, anybody seen this website before, Funding Post? Here, let me click on it quick. See if I can actually get at least one of the damn links in my PowerPoint to work. Yeah, so this is a great, like, it's a great list. They've got like, I believe there's a little bit of sign-up work you have to do, but basically there's long, extensive lists of like different investors, the profile, you know, like what they look like. It's basically like a database full of different venture capital firms and angel investors. So that's that. Tech Coast Angels, has anybody heard of them? Tech Coast Angels is an angel investor group, so it's basically it's a club or a networking group of people like Bruce in the LA area who invest in tech projects. So actually, they're not really Bruce, because Bruce doesn't really invest in many tech projects, but otherwise they're rich angels that meet once a month and talk about investing in tech projects. So this is the website of that group of angels. You can find all kinds of information about the kinds of business they invest in, what is necessary to apply to them to like present your business and see if you can get funding. That's all in here as well. Angel Capital Association, another sort of list of different angel investors out there in the world. Great information on all kinds of different angel funding sources. And then finally, Kickstarter, crowdfunding. I've put that in here as well. Kickstarter is not the only game in town anymore. There's some other crowdfunding sites as well, but I haven't updated the slides yet. So just some basic resources for you guys, and that's the end of the show. So just once again, because I'm not going to see you guys on Monday, you're welcome to come here if you want, but next Monday, all you need to do is take the quiz on Blackboard, and I'm going to send out a link again. I'm going to make sure to make a note of myself to do that. with a it's a link that will send you to the continuous improvement page. I'll show you what it looks like quick. Okay, so I'm going to send you an email with a link which will send you to a page which looks like this. And I don't want you to like put your name next to this or anything. I don't need this. It's supposed to be anonymous. If you have any suggestions for me on how could I make the like how could I help you learn the subject matter better? How could I offer more intellectual challenge? There's a bunch of different areas that basically track exactly to the SOSI form. Not surprisingly, because I want to make sure that I do my best job possible, so you guys give me good ratings. If there's anything that you think I could be doing better, we've still got a whole half of the quarter in front of us. I'd like to hear what I can do, and I'll try and make those changes. Okay? So no need to tell me who is making the comment. Just tell me whatever you think I could do to make the class better, and I'll do my best the second half of the quarter to do those things. Brian, yes. And then Susie after you. Go ahead.
I think I noticed that the quiz is available right now.
Uh-huh.
Can we take it before?
Yeah. You don't have to just.
You're going to change it? Or
No. I'm not. The quiz is what it is. You're welcome to go in and take it now. Susie. Yes. I believe it's 30 questions. Each of them have 4 choices. There's one correct answer. Each question is worth 4 points, and then I give everybody 5 points just because I couldn't, it was too much of a pain in the butt to make each question worth 4.1275664, and I need to give you 125 points total for the quiz, so I'll give everybody 5 for free, and then each question you get right is worth 4. Okay? Other questions?
If I can't be here next Thursday, what would I do?
Thursday? You mean Wednesday?
Yeah, Wednesday. That's okay.
It's fine. Basically, if you can't be here, make sure that you coordinate with Vincent and
gave them
Rochelle.
all my contact info,
Otherwise, it's fine. I mean,
Okay.
if you have a job interview or you have a family member who's ill and in the hospital, if it's something legit, give me some documentation. I'll give you your
Okay.
your
Yeah,
credit
it's kind of
anyway.
hard. It won't be that.
But otherwise,
just
it's only 6.25 points.
Yeah. So,
Fine.
and then on what was the other thing I was supposed to ask you? I wrote 2 things down. Probably charge my computer instead. And my list
When you're,
is on-
what's up?
Give you a heads up. I won't be here on the 26th.
Which
That's Monday.
Monday? So it's not next week.
No.
Is
I
the
think
Monday
2
after?
Like 2 weeks from.
That's fine.
Yeah, because I have a business trip to Idaho.
Cool.
Yeah.
Yeah, that's fine, man. If you send me some kind of email describing the business trip, I'll give you the 6.25 points
Yeah, it's
anyway.
for the restaurant franchise that I was telling you about. So it's going to be a whole day conference. And
Yeah, send me some kind of agenda for the conference or whatever,
yeah,
and I'll give
we
you the
can do
credit.
that.
Okay.
Yeah, it's going to be a whole day conference. And I already reached out to Dr. Stark for the individual study for next quarter.
Did you talk to him?
I sent him an email, so I'm going to call him tomorrow. I called him today. He's out of town, so he'll be back tomorrow.
That's fine.
So I'll talk to him.
Keep
and
me
I'll send
posted,
you an
man.
email.
Yeah.
so
Let me know whatever I need to do, and we'll
we
make
can
it
move
happen.
forward with that, our requirements and everything. So
Cool.
We'll see. I'll let you know.
Okay.
All right,
Sounds
thanks.
good, man. Have a good rest of the week.
The only thing my computer cannot do is hard. If I make it go to sleep with 10% or less, it shuts down. Once it loses its battery, it just drains really fast. I think it's because it's old, and I probably need to get a new battery.
Could be.
I've had this. I like my. It probably is because it's old. Because the old one I had before I got my. Well, now it's a year old, but this one I got. This is a Cal State computer. They gave it to me as part of my deal. Well, they didn't give it to me. I have to give it back if I ever leave, but I get to use it all the time. That one doesn't. It'll go all the way down to like 5% battery power before it shuts off. But my my older one, like,
mine will go all the way down to like 0%, and I'll be working on stuff and then I'll shut down. But I mean, if I had it unplugged and then shut it down like 10% at night, and then wake up in the morning, it's gone. So I usually charge it at night.
oh, I see. So even if you shut it off, it still keeps losing battery power.
Once you shut it completely down,
Yeah.
if you're just leaving it.
Got it. That I haven't noticed with mine. Oh, gotta remember to turn off the podcast.
The other thing would be like questions.